to go ahead and get started with our webinar today. I would like to let everybody know that we have the chat feature opened. I will be checking that periodically throughout the webinar today. So if you have any questions, please post them there. And when I get some time and some moments, I will go in and look at those, and then we'll have some time at the end of the webinar as well to answer any of those questions as well. Let's get started here. So one of the things I'd like to show on the screen here is that if you would like a complimentary, no obligation financial consultation with us, please visit our website at bogartwealth.com, or you can scan this QR code. It'll take you directly to that consultation request. If you have not had one with us or had one with a financial advisor, I would encourage you to sit down with us and have a complimentary one-on-one session just to see if there's things that we can help you with or that you want help with in preparing for your financial future as well too. So again, this is me here. I am one of the senior vice presidents, financial advisors here in the local Texas office. A little bit about Bogart Wealth if you are new to us. So we have 3 different offices. We were founded officially our 10-year anniversary. We celebrated this past summer here. Our offices are located in Virginia, and we have 2 in Texas, the Gessner location at Memorial City, as well as our Hughes Landing office in the Woodlands. We have about 50 plus employees, ever growing over the last couple of years here, about $3.6 billion in assets, and about 1,500 clients. A little bit about today's agenda. We are going to go over a little bit about some of the retirement risks that clients are faced with today, a part of the income planning process that we take our clients through and that we feel that most people should go through when they are looking at preparing for retirement and that financial independence. Some more detail about what goes into the retirement analysis, the investment strategy, the different withdrawal strategies that are out there, and then kind of what that looks like with reviewing and monitoring your progress to make sure that you're successful in retirement, as well as just dealing with emotions. Retirement decisions can be a little overwhelming, and some people are ready to retire, other people aren't. So there's different emotions that people go through on those cycles. And I think it's important for people to kind of recognize that that's normal and how we work through those different types of cycles that people go through as well. So the first thing is to ask yourself, why is a plan important? It's important to make sure that you can make educated decisions and not make wrong decisions based upon what you heard your coworker or your neighbor or your family say, or that you read on the news, or you watched a certain interview or something like that. And so it's important to make sure that you have your own vision for your own future. Not all plans are created equal, and what your neighbor decided to do doesn't necessarily mean that that is what works best for you. Part of it is really solidifying what your current and future cash flow needs are. Again, I think the plan will help with that emotional piece that I just briefly touched on, of feeling comfortable and confident with the decisions that you're making, knowing that you've done all of the planning for that retirement, and that you are comfortable. You only do retirement once for most individuals, and so you want to make sure that you have addressed all the different needs. And so kind of putting through that plan and that analysis will help solidify those decisions as well too. Having that plan also allows us to build that investment strategy. Sometimes we don't necessarily do the retirement plans just to make sure, we can retire. A lot of times people know that they can retire, but it's a matter of creating an investment strategy based upon your numbers and what your goals are as well too. And along with that, the plan can help allow us for withdrawal strategies, spending strategies while you are retired, as well as making adjustments to the market if you fall ahead or behind with your plan as well too. So part of going through that retirement planning process is it's going to plan for and minimize a lot of the risks, so that we as advisors, when we're putting this plan together, we can kind of foreshadow a little bit of some risks that we have coming up down the road, whether they're 5 years, 10 years, 20 years from now. So by putting that together, it's not so much about worrying about what's going on today, but foreshadowing and forecasting that what are some risks later on down the road, whether it is running out of money, long-term healthcare costs, estate taxes, required minimum distributions, all of that. So it helps us kind of minimize some of those things. So if there are things that we need to do today and make some adjustments today, it's better to know that now, or know the types of things that we're going to need to address over the years so that we can have a smooth path for retirement. Again, helps you make informed choices about funding your retirement. A lot of times we work with people who are already toward the end of that. So it's not so much about funding your retirement potentially of accumulating. It's a matter of making sure that we have our assets last to fund that retirement. A lot of times people don't realize that they might be retired longer than they worked. So we've had a shorter period of time for accumulation. So we really need to make sure that we are focusing on what that plan looks like, what our goals are, and making sure that whatever those are, that we can put together a plan for you to achieve those goals there. For a lot of individuals too, it can help determine a sustainable withdrawal rate. Again, part of that is dependent upon the size of your portfolio and how much you want to spend in retirement. But that plan will allow us to kind of know where we're sitting, and that also impacts some of the different investment strategies and the types of portfolios that we might utilize during that plan. And then also putting together that first initial plan gives us the foundation. So we want to have a really good plan going forward. We don't necessarily need to know all of the answers, right? We don't necessarily need to know exactly where our retirement home is going to be or where we're going to be based out of, but we want to have a really good foundation. So then from there, we can continue to monitor that and make sure that we're staying on track as well too. I definitely think it's important for individuals to make sure that, again, it's whatever your vision is for your future. These plans are very customizable to what your end results are, whether that is to spend all of your money and leave nothing behind, to create a legacy, to help fund goals through retirement, whether it's for your charities, your family, your children, things of that nature. So it's really important to kind of look at your family and how does that impact what your planning needs are. Your health is a huge part of it. Staying both mentally and physically active throughout your retirement. Changes in your health situation, whether it's yours, your family's, your parents, your spouse, things of that nature. How does that impact some of your retirement plans as well? A big one is, where do you plan to live in retirement? We do see a lot of people either, getting a second home or just moving, following their children, different things of that nature. So that's a part of it as well too. Are you going to downsize? Lots of different issues. So again, sometimes those are things that people don't necessarily need to know, but it's nice that if you have a plan, then you already have a good feel for what your financial situation looks like. So it can make some of those decisions easier to make later on down the road as well too. Looking at your lifestyle, what are your hobbies? When every day is a Saturday when you retire, making sure that you have that fulfillment of those days as well too. Some people will struggle, with that a little bit if they don't have something to do every day. So kind of understanding what will fulfill you during retirement. For some people, it's work, part-time work that's maybe on their terms, so that it's not subject to a rigorous 40+ hour work week, but maybe filled with either some contract work that is part-time, or at least something that you enjoy doing, or it might be hobbies, those kind of things that actually have some form of income to you as well too there. Another piece is legacy. For some individuals, it's important to leave money behind to their children or to charities, to organizations, not necessarily just at their passing, but also throughout retirement as well too. So those are some things that we will work with to help make sure that those things are accomplished as well too. Again, and kind of last one, mind and spirit. What do you want from retirement? Do you want a peace of mind? Do you want some flexibility? Do you want some comfort? All of that. Our job when we're creating this financial analysis is it really just kind of lets us know what are some more financial type risks. And then it's our job as the advisor to really kind of put that together. So it's definitely more the science is the actual numbers, but the art of it is our job to say, okay, these are all of the things that you told me that's important to you and that you want to do. And now that I know your financial situation, how do we put all of those things together to create this fulfilling retirement for you? When we look at people's greatest retirement concerns, we definitely see that they do change as we are accumulating and preparing for retirement. And then once we actually shift over into retirement, definitely a little bit of changes, but they're relatively consistent. The biggest one that we start to see initially in the planning is outliving your savings and investments. And I think that's a lot of everybody's fear. Once you've gone through the planning process, because it does give you that peace of mind and that comfort of knowing that you've looked at everything and that you have all of your ducks in a row. You can see here that it shows that people feel a lot more comfortable, that they're not really concerned about outliving their savings at that point in time. And then another big one you'll see is the healthcare. So kind of in the middle of the picture here. Again, a big drop there too. Part of that comes to outliving your assets with part of the planning process to let clients know that we've prepared for that, to make sure that if we were to have a health event, whether it be a short-lived or a long-term health event, we want to reduce that fear and that stress of it. And again, I think going through that gives people a little bit of comfort, so we're able to kind of take that away from you as well. You'll see that a lot of people, one of your biggest expense in retirement does become the healthcare. So it's a very valid concern for people. But a lot of times what you'll see is everything is essentially gone down throughout this planning process, so that once we've gone through that and you're actually in retirement, that dark blue, that there is that sense of comfort. And I think that's really what the biggest thing to gain is from doing these retirement plans specifically for you, as opposed to just going online and the numbers telling you that everything is fine. So kind of going into, some specific risks that people have. Obviously, there's just 4 listed here. Those are the bigger ones. There can be some other smaller ones along the way, but for a lot of people, longevity. The average couple, age 65, 42% chance that one of them is going to live to 90. 16% chance that one will live to 95. So for us, we typically do our planning to age 95. And that's kind of progressed over the years. We started out, years ago doing it a little bit sooner, and currently right now we'll plan to 95 unless somebody asks us to either extend it because their family members have lived longer than that, or if there are some health conditions that they just, are very adamant that they don't want to look at that planning there. But the idea is, to my point of, we're going to be in retirement longer than we worked, right? Like that's where when people are retiring between 55 and 60, we're still projecting, 30 to 40 years worth of retirement. So it's very important to make sure that we have everything in order and that we're addressing all of those risks. Inflation is another huge one. There, obviously, that starts to erode away our purchasing power throughout retirement. And so we want to make sure that the decisions that we make, we have some flexibility so that if inflation is a little bit higher than normal, we have some adjustments we can make. We do know that inflation is a huge part of it. So it's very important to make sure that we do have some flexibility for the rising costs that we will face with in retirement. Market performance, obviously something that we can't control as advisors, but we definitely want to make sure that we put your portfolio together to avoid mostly what people are familiar with is that sequence of returns. Some of the worst things that can happen to somebody when they retire is those first 2 years. If the market drops substantially, let's call it a 20 or 32% drop, when you're 90, not as big a deal, because the end of life, we only have a couple more years worth of planning. And so we don't need that time to recover. But when it happens early on in those first couple of years of retirement, when, our withdrawal rate, we're well within our withdrawal rate, but all of a sudden we lose 20 or 30% of our portfolio, our withdrawal rate at that point in time now might go from a 4%, which might have been a very safe rate, to 6 or 7, or even more than that. So that's one of the risks that we have. And so one of the ways that we try to overcome that risk, we'll talk a little bit about some of the different strategies from investments, as well as withdrawal strategies to help to protect you with that. And then the last one is the healthcare costs. Again, lots of different ways to help protect us from that, of looking at if somebody already has some long-term care policies, or separating out and self-funding that in different ways if that is a concern, or looking at the projections of your portfolio to make sure that should we have a healthcare concern come up, that we have adequate assets to be able to cover that. So part of it is, one of the biggest focus is really kind of looking at that spending in retirement. It's very important to know what your lifestyle is. And so I find it very important to make sure that we go through a budgeting kind of session for people. So a lot of times we'll find people, they make substantial income, and so they don't really have to budget. They just know their paycheck is coming in and they have extra money left over, but they don't really know what they're spending. So it's really important to kind of go through and just take a look at, what do I need on a monthly basis? And I like to categorize it into basically 2 different buckets. The essential expenses, so the things we have to pay to keep the lights on and day-to-day activities. So, property taxes, insurance, utilities, things of that nature, mortgage, if we still have a mortgage in retirement, the basic expenses that we really can't adjust. Okay. So kind of knowing what that number is, and then looking at the discretionary. And the discretionary is the part to where that's our lifestyle, right? Do we like to eat out? Do we have hobbies that we have to pay for? Do we like to travel? Do we, have, home renovations, gifting to children, all of those kind of things of what does that look like? So that if we ever needed to make adjustments, that discretionary bucket is the one that we're making adjustments for. Again, might not be important for everybody. You might be able to have that freedom and flexibility to not worry about what that is. But part of it too is really just kind of going through that session so that you just know what you are spending. It can be eye-opening for people. People sometimes just don't realize where their money is going. And so when we're making decisions on withdrawal strategies and income sources, it's nice to know what those essential expenses are, because for some people, they want to know that no matter what, their essential expenses are covered. So, right? So we need to know what that number is. We need to know if you're spending $200,000 a year, $100,000 of that is essential expenses that I'm not going to have a lot of flexibility with. So again, going through that will let us know, maybe we want to make sure that our guaranteed income streams cover all of our essential expenses, because in years where if the market is not participating, or, we're just wanting to do something different, then we could make sure that, okay, I at least have my essential expenses covered, but maybe I don't go buy the new car, or maybe we don't do the big family vacation that we were planning on paying for. So those are the kind of things that we look at of making sure that we have all of that taken care of. Do you set aside money for emergencies? I feel that when we are working and we're accumulating, we always want to have an emergency fund or a savings fund for a rainy day. And the reason why we do that is because we typically don't have access, right, to our other assets. We don't have access to a pension. We don't really have access to a 401k. And so we need to be able to say, if I have a medical expense or I have an emergency, I need to have money that I can tap into without paying a penalty to get to. Once we're retired, typically, depending on how old you are, the idea of an emergency fund isn't necessarily a requirement, because now I have access to everything. Now, taking a step back from that is still a part of your portfolio to make sure that if we had some unintended expenses or something like that, that I'm going to be able to tap into a portion of my portfolio and not be worried about what the market is. But the idea of, just keeping a slush fund or a larger cash account in retirement, the mentality of that switches up a little bit. So sometimes it can be a little harder for people to kind of make that switch there. And then the other question is, do you increase your income annually for a living adjustment? And Typically and then the answer to that is no, right? So the planning software that we'll use will have that inflation built in. So every year it's going to increase your expenses. So it'll keep if you have a mortgage, it'll keep your mortgage flat because that obviously doesn't change, but everything else is going to increase with inflation because we do realize that's there. So from a planning perspective, the plan is going to err on the side of conservative to where your expenses are rising every year in that plan. However, what we actually see happen though is not every January do I go in and increase my clients' monthly distribution by 3% or whatever number we've agreed upon. If that doesn't usually work that way. What typically has happened is that, we'll be in retirement and for a while we'll be fine. And then all of a sudden, maybe a couple of years go by and people say, you know what, it's just not going as far anymore. I'm always calling for a little bit extra. And so at that point in time, we'll kind of take a look at where the expenses are and then increase their monthly draw. And that has, stayed true throughout, even after COVID. A lot of people, when we saw expenses go up and inflation was very high, honestly, people weren't really calling for that. It took a while. And so now at this point, if I haven't increased somebody's monthly draw over the last couple of years, we're probably doing that. So that's one of the things to kind of think about on how do we account for the cost of living every month and every year with that. We look at kind of expenses. This is a really nice chart just to show as we get older, the dispersion of where our expenses start to drop. And so obviously normally when we're younger, I'm sure everybody has heard of the go-go years, right? So we're younger, we're more active, we have a lot of things going on. And so we're spending a little bit more. And then we have a little bit more of the slow go years, right? So depending on somebody's age and when they retire, though, that go-go phase might last 5 years, 10 years, 15 years, really just depends. And then eventually we're slowing down. We've done everything that we wanted to do potentially, or we're just not as active as well. Our health potentially might be slowing us down. And then we have the no-go years as we definitely get, for this example, 75. So, a lot of the discretionary type of expenses start to decline, but you'll definitely see the healthcare, right? Like that's the piece that does start to come into play and pick up there. So part of the retirement income planning process is, again, it's not a one-time event. It's that initial foundation to, have your basic analysis done, and then from there continuing to update it. So the first part of it is that retirement analysis where we're going to really look at all of the details of what your plan is. And then from there, that helps us create the investment strategy, which goes hand in hand with that withdrawal strategy. And again, since we call it a process, not an event, it's because we're always going to be monitoring and reviewing that as you go through retirement. And most of the time, it's because we don't know exactly what that retirement is going to look like. Even people who think that they know exactly what those next 30 years are going to look like, things happen and things change. So we're always continuing to monitor that, as well as the market. We've had a really good bull market. And so people's plans, might look really nice so that maybe they want to, increase some spending, or maybe the projections for the end of life value of their plans now is maybe a whole lot higher than what we were originally planning on it to be. And so now maybe there's some R&D concerns, or there's some estate tax concerns later on. So again, this is a process that is continuous. And it just depends on how much your situation is changing as far as how often we update some of those planning numbers. But from a monitoring and a review standpoint, that is always continuous. So when we first look at that first piece of the retirement analysis and really kind of what goes into that, like when I talked about your spending and what does that look like here, right? Like that's really what it's about, is prioritizing your goals, looking at what your expenses are, and figuring out, how much money do I need to retire on an annual basis, and then going from there to kind of look at that as well too. So once we've gone through all of those budgeting expenses and had a discussion about what your goals are and what those lifetime goals, expectations are, and things of that nature, all of those things are the things that we put together in that plan. And for somebody, if they are not sure, right, like what that is going to look like, because we've done this, for, for a really long time and worked with thousands of people, there's a lot of things that maybe you don't consider important or just don't even think about that we'll bring to your attention and say, well, what about this? Or typically you've seen this happen. So it's really nice to be able to work with an advisor who might know if there are some holes that you're not thinking about or how other people have looked at their expense piece there. So again, we will go in and kind of look at those inflation assumptions for you. Very important to make sure we specifically will inflate out your healthcare costs a little bit higher than your living expenses because they are rising much faster. So that's what we will do. We can also build in extra costs later in life if somebody wants to look at doing something like that, or if they already have some long-term care insurance. How does that incorporate into their plan? So maybe maybe I have a small plan or I have a Cadillac plan that's going to cover all of that, right? Like bringing all of that into the plan and seeing how that impacts your final numbers. We look at all your income sources. So Social Security, any pensions that somebody might have, all of your assets, rental, business income, part-time employment, all of those kind of things. And then also helping you, make decisions within how to take those income sources as well, too, if you're faced with, taking a lump sum or taking the annuity, and what does it look like from a survivor benefit standpoint as well, too. This plan will help us analyze all of that data. And then obviously the whole goal of this is to make sure that all of the things that you want to do when we put it into the analysis, that it works, right? And so if it works, great. We're there to identify some strengths and weaknesses of the plan, some things that we need to address, whether it's taxes or investments. And then if it doesn't work, right, if we're not able to achieve all of our goals, then what are some things that we can do to get there, right? Like are there some small tweaks to additional savings, or maybe we need to work a little bit longer, whether it's full-time or part-time work. That the idea is not to put this information in the plan and say, okay, it works, and walk away, right? If we are here to provide solutions, so helping you make sure that that plan works for you and your family. So if we take a quick look at all the different sources of retirement income that people have there, obviously Social Security is a big part of it. If I'm planning typically for my younger investors, maybe, under 40 potentially, I may or may not be including Social Security into their analysis, but for most of the retirees that I'm working with, Social Security makes up a large part of that. So that is important to add into the plan, and then making sure that we make those decisions of when to elect Social Security, how to elect it, what do those strategies look like as well too. And the plan can help us determine the right election strategy for that. The pension, few and fewer people are having pensions nowadays. If you're not a government employee or ExxonMobil employee that we work with, right? Obviously, we still have that. But a lot of people nowadays are not having these pension plans. So that is an important piece for some people. And then, of course, the bigger one is the savings and investments. And that kind of fills in the gap between those guaranteed sources of income as well. So once we kind of gone through that retirement analysis, we're going to look at the investment strategy. So when we look at the investment strategy, there's basically 5 different, elements that you can kind of look at. And I know there's going to be some other ones out here, but these are 5 of the bigger ones that I think a lot of people will look at and kind of say, is there something that I'm missing, or what are some other opportunities that I have out there? So the first one is annuities. We do have people come to us, they have annuities, or they're interested in whether or not they should buy an annuity. So that's obviously a part of it, whether it's a fixed indexed or variable annuity. Bond ladders. Don't necessarily see too many bond ladders right now, because a lot of these investments can also be dependent upon the current environment of what the market is doing, where interest rates are, things of that nature. But those are definitely an option for people, whether they're corporate bonds or government bonds. Income-oriented investments, so employee stock that generates a dividend, or a basket of stocks that generate a dividend as well too. Master limited partnerships, things of that nature. REITs, all of that. So that can be an important part of somebody's portfolio, depending on what their goals are. And then the last 2, a fixed asset allocation is basically, let's say you wanted to have a 50-50 portfolio, 50% bonds, 50% equities, and that was just your mix, right? And so then just kind of saying that's where I want to be and just always rebalancing back to that 50-50. The last one is a dynamic asset one, is where it's that idea of this ratio of bonds versus equities, but then also having, kind of looking at the market and looking at your spend levels and all of that kind of stuff, and being a little more proactive about what's the market doing, and again, more flexibility to be able to move in and out of those as well too. So again, not all of these are typically things that we're doing for individuals, but they are all of the different strategies. So when we do the financial analysis, depending on what the results come out as and what your goals are and your comfort level with risk, that's where we really start to create this investment strategy that really goes hand in hand with now, picking the investments that work for whatever my withdrawal strategy is that I want it to be. So quickly, a little bit about the annuities, because I do think that they just get a lot of news out there. If the market's not doing well, and sometimes you'll see some of these fixed or index annuities will be really popular. If the market's doing really well, you typically don't hear about a lot of these. But there's three types. A fixed annuity is just kind of like a CD. You put your money in for a set period of time. It's essentially locked up, though. You have surrender charges if you needed to access it early. But then at the end of that term, you get to walk away and they'll pay you your interest. So sometimes we'll see 3, 5, 7-year fixed annuities. So think of that as like a 3, 5, 7-year CD that you might be able to get. And then the indexed annuities are going to be linked to some index, whether it's the S&P 500 or some blended version of an index, to where most of the time you have no risk of losing any principal. There's a floor there that says, you're not going to lose any of the money you put in. And then you'll have a percentage of the market appreciation that you will get. There's usually a cap. So if the market goes up 10%, you're not getting to take full advantage of the market. There's a participation cap rate that you'll get. And then variable is very much going to be associated with the market. So you're not going to have downside protection. You're not going to have guarantees unless you actually choose that type of investment in there. But they're going to be variable accounts that are very much similar to like a mutual fund or an exchange traded fund. So you get to pick your risk and pick those allocations there, and they're going to move with the market. Bond ladders. Again, we would use these when interest rates are very favorable and you want to have some guaranteed income to come due. So, sometimes kind of like a fixed annuity or a CD where you can buy some 1, 2, 3, 4, 5-year bonds. Obviously, I know some of these can go much longer out and be incorporated in as an income stream if you get some really good interest rates out there. But we used to use these to really kind of say, for the next 12 months, I have cash and I'm using that. And then in 12 months from now, when I deplete my cash account, my bond's going to come due, and that's going to be my next 12 months. And we just kind of create this ladder for whatever period of time is most appropriate for your goals and your overall risk tolerance as well, too. When we look at obviously more of those fixed allocation and those dynamic allocations, it's really, looking at some of the overall market here. And so for some people, they do like the idea of having guaranteed income. And again, this can kind of go back towards once we know what our essential expenses are, it's nice to know that maybe I have 50% of my essential expenses covered or 100% of my expenses covered. That's how some people might choose to look at this and say, what's more important to me? And so a lot of times we will see that, the path at the end, growth versus value, which is typically the value is where the income oriented investments, might end up the same at the end, but the path there looks very different. Now, obviously, in today's environment where, there is some heavy growth on there, obviously that might look a little different going forward of, value versus growth. But the idea is that you can see on the growth piece of it here, you see some of those fluctuations in the market, right? So you're feeling a part of that volatility in the market. And that may or may not be something that you're comfortable doing with a portion or all of your accounts. And then if you look at this on the right here, this dividends paid side, it's a much more slower pace there. So you're still growing your accounts as well, but you're not really seeing a lot of the variation. So these companies are paying consistent dividends, and they still do grow, but they're not trying to grow as fast as the market. So one is not better than the other. Again, it's about incorporating how do you want to structure your portfolio? What do you value more, and what your comfort level is within those accounts as well too. This is here just to kind of show you that there's never one piece of the market that's always going to be the best performer. And so that's why sometimes it's important when we look at whether it's those fixed allocations or those dynamic allocations here, to be able to have some flexibility to move around. And we're not trying to find the next best performer, but the idea is that there's different sectors in the market consistently over the years, as well as not just sectors, but market capitalization. So, international, domestic, large, mid, small, those kind of things. That chart looks just like this too. So the idea is that if we're able to make sure that we're participating in the market, and so we're not just sitting all in one sector of the market, because at that point in time, we don't know if that's going to be the number one performer for that year. So having a well-diversified portfolio will help allow you to take advantage of the market, but also give you some of that protection on the downside as well. So getting into, I think one of the questions that I get asked most for a lot of people is figuring out, like, how do I recreate my paycheck, right? You're used to getting your paycheck, once a month, twice a month, whatever your pay schedule is. And so, how do I do that, right? And so one of the ways is looking at that withdrawal strategy, whether it is from, percentage of your portfolio that you're living off of, as well as which investments do I pick and choose to take that from as well too. So when we look at doing something like that, for some individuals, income only, right? They might have, a need for $200,000 a year. And so they want to generate all of that as income within their portfolio. So keep in mind, you might have some Social Security, you might have a pension coming in, and then you look at dividend income and interest and things of that nature. That's what we think of with income only. It basically means that you're never having to sell a position, and you're just living off of that. Depending on the size of your portfolio and your income need, may or may not be doable for some people, right? And there's a risk component to that as well too, to where if somebody has all of their investments all in dividend paying stocks, then they need to be comfortable with having maybe 100% equity portfolio, right? And a lot of times you'll read and you'll watch things on TV that'll say, as I get older, I should have less equity exposure and more bonds, right? So there's sometimes this disconnect that people might not be comfortable with doing that, but it is a very valid strategy for a lot of individuals, as long as they understand the risk and it works for them as well too. And you might change your strategy as you get into retirement as well. You might go in thinking that you want systematic withdrawals, and then 5 years from now, you might say, you know what, I value more of having a consistent income coming in. So again, part of the plan allows us to kind of take a look at all of that and reevaluate every year if your goals and comfort levels change. And you want to make sure that your investment allocation that you have might have that flexibility for you, and that you're not set in stone when you make those initial decisions to say, well, that's what we're going with for the next 30 years. So I think it's important to understand, how things might change over time. So if we look at systematic withdrawals, it's really a matter of just saying, I'm putting my investments in this bucket, and I'm just going to take out, the withdrawals on a monthly basis, and no matter what the market is doing or anything like that, and taking those withdrawals. The bucket approach, we'll go into a little bit more detail as to where we kind of break up your expenses into typically 3, maybe 4 buckets. The easiest way to explain it is, we'll have a cash bucket here that's not subject to the market, and then we'll have a little bit more intermediate term bucket that has less risk, and then we'll have a growth bucket, and then we might have an aggressive growth bucket on top of that too. So when we're looking at this, it's our job as advisors to kind of say, based upon everything you told me, this is how I would put your portfolio together, but also kind of explain some of these if you go in not knowing which one is important to you as well too. I have a few questions that come in, so I'm going to kind of stop here and answer a few of these. Somebody asked that, do most retirees need to work part-time, full-time, or do you find that it's used to level up their activities, purchases, or fund money? Um, I think it depends on the situation, right? I definitely think that there's an emotional component to that of when you switch over from an accumulation phase of saving all of a sudden from a spending phase, right? I think sometimes there could be the this kind of level up your activities or your comfort level with being able to draw, to draw that down, that some people just don't want, maybe to start that withdrawal phase, at 100%. So maybe they kind of want to, ease that, but it also can be the fun money component to where somebody said, look, I had a really good salary before, but everything that I make on my fun part-time job or something like that is going to be my travel bucket, right? So whatever that looks like, right? I'll work a little bit and then we can travel, or we can use it to give money to the kids, do some home renovations, things of that nature. So it really is just dependent upon what their situation looks like. I find that a lot of people sometimes might struggle with suddenly retiring and not having anything to do. So I think sometimes the idea of this part-time is more about filling up your day, right? And kind of like, what do I do all day? The initial phase will be, first couple of months, you might have, a big to-do list of things around the house or travel or grandkids or something like that. And then when all of that stuff is done, at that moment, you sit back and say, okay, right? It's like, now are my days filled with this much stuff? And then sometimes it can go the other way to where, yeah, you're able to spend more time with your family and all of that. And so you appreciate that. I think when I feel like when COVID happened and a lot of people were forced, to be home for a certain period of time. Some of us were home longer than others. I think it was eye-opening for a lot of people to either realize, yes, I'm ready to retire because I enjoyed being at home and I enjoyed being around my family or doing all of these activities. And then other people realized, you know what? I didn't enjoy that. I thought I was ready to retire, but I didn't want to be at home. All of that. So sometimes we just never really know, what to expect. And some people are easier to disconnect and others are not. And then another question is not to get caught up in the volatility of the market. It was recommended to not check your portfolio daily. What guidance do you usually give about checking in on the account? I will tell people not to check in daily, obviously, right? Because the volatility of the market right now has been extreme. And so to see the day-to-day volatility can be an emotional roller coaster. So even though you might not do anything, nobody still wants to see their account lose money on a given day. So sometimes I'll tell people, if you're going to check your account more frequently, check on a good day, right? Like if the market is down 3% today, probably don't log in and check your account. But if the market was up from an emotional standpoint, sure, why not? But what a lot of people will see is even if you just did it monthly, you'll avoid all of that volatility and not realize, how bad it was. And I'll see that with accounts to where we'll do quarterly meetings. And as I see the market moving and I see performance of accounts moving, it drastically can change on a weekly basis kind of thing, where suddenly, maybe a certain strategy is a negative. And then all of a sudden, 2 weeks later, when I'm pulling up performance numbers, it's swung the other direction. And for people who didn't check it, they didn't even know, right? And really, we're just trying to avoid the downside. We're all happy if we make money. But what happens is that when we get performance numbers, we always gain money in percentages. Usually people will say, I made 10% last year. I made 15% last year. But when we lose money, we don't lose percentages, right? Somebody doesn't say, I lost 10%. They'll say, I lost $1 million last year, or whatever number it is. And so sometimes when we equate that, when we look at that in a day, if you're checking your accounts and the market's down 2%, which is somewhat relatively normal in today's environment, you're looking at your accounts and you're not saying I'm down 2% today. You're looking at it and saying I lost $50,000 today, right? So that mentality of kind of figuring out, you need to know what your emotions are, what you can withstand, and you want to be able to ride out all of that volatility. So daily basis, not recommended unless it's a good day. And I think again, it's a matter of finding that confidence where you don't need to check them daily. Now, if you're a trader, you're checking them daily. If you have a brokerage account and you're trading and you're doing all of that, you're going to see all of that. But when you've done some proper planning and you have your portfolio set up, honestly, on a quarterly basis, really should be sufficient because things can change very quickly over that period of time. So I hope that answered your question there. Any more, please send them that way. So let's talk a little bit more about kind of diving in, a little bit to what some of these strategies might look like for people. And again, sometimes it can be a combination of these strategies. Sometimes it could just be one for the moment and then switch later. On an income-only strategy, like I mentioned, it's really never touching the principle of your portfolio and just creating an income only. So we have Social Security for individuals. Maybe there's a bond ladder, maybe there's some other kind of CD interest or something like that, and then you have some dividend paying stocks. So the idea is this is just spitting out money every month, and we're living off of that. Now, one of the things happen is that Social Security might not be immediate, right? So sometimes you might start out with a withdrawal strategy to bridge the gap, and then once Social Security comes in, whenever you choose to elect it, then maybe you can be 100% income only at that moment. So this could vary for people as well. The systematic withdrawal, again, in this example, you have $1.5 million. You need $5,000 a month. You're getting a little bit from Social Security, and we are just pulling money out of our accounts in a balanced portfolio and just pulling it out. So the money is fully invested at that point in that type of strategy, and we're just taking that withdrawal rate. A lot of this depends on what your withdrawal rate is, right? So that in this situation, it's a smaller withdrawal rate. If you're needing a larger amount, something like this may or may not work for you if your income need is a higher percentage rate. So then when we look at the bucket strategy, and I would say it's not that one is more favorable than the other. The bucket strategy is really good because what it does is it helps alleviate a little bit of the market volatility and some of the concerns that people have. When we think about one of the biggest risks that we had, it was market performance, right? And so we don't want to be pulling money out of our accounts when the market is dropping. And there's no guarantees in the market, but we do know that there are going to be times where the market is not doing good, right? Guarantee that the market's going to be down at some point. We just don't necessarily want to be selling when the market is down. So the bucket approach, as well as the income only approach, can work really well to kind of allow us to protect that volatility in the market. So in this example, same $60,000 need, you have $1.5 million. The idea would be looking at, putting aside money in bucket one, which is our guaranteed bucket there. So in this situation, if somebody wanted 5 years worth of, I don't want to be in the market, I want to have asset preservation, no volatility, right? And so that, could be 5 years, 3 years, depending on somebody's comfort level. So in this situation, you're putting $300,000 removed from the market typically. I know this says some high grade bonds here, which are obviously not guaranteed, but the idea is that bucket one is zero risk, essentially. And then bucket two is that intermediate. And again, bucket two can move as well too, depending on somebody's risk profile and their asset portfolio as well too. But the idea is that I'm going to put money in bucket two to replace bucket one, okay? And sometimes we're not necessarily waiting until the end of year 5 in this example to now suddenly replenish bucket one. If bucket two, maybe, the market, since it is doing some bonds and things of that nature, if the market was down that year, right, we still have money in bucket one. So the idea would be reevaluate what's in bucket one every year. How is bucket two reacting? And then maybe you do keep 5 years, worth of bucket one. So we're shifting money from bucket two into bucket one if need be. And then bucket three is basically my long-term money. So again, in this example, it's showing 13 plus years out. Doesn't have to be 13. Again, very much dependent upon your asset size, what your comfort level is. But that's the idea of kind of creating this strategy. So we're able to keep up with inflation, right? Because we actually have our money invested, the bulk of it invested in things that are keeping up with inflation. We are protecting our sequence of returns, right? Because we're able to have money that we're going to be able to pull down off the market that's not going to be at risk. So that's why this bucket approach works really well for people, because two of those big risks are taken off the table that are out of our control. So this is a way to make sure that we're able to do that. So part of all of this is, we looked at kind of what are people's concerns and how much, how long will my money last? Again, very much depends on what your portfolio allocation looks like, as well as what your withdrawal rate is and how much you need to retire. The idea of somebody saying everybody needs X number of dollars to retire, throwing out a number, sometimes it's, 2 million, sometimes it's 5 million, things of that nature. You don't know that, right? Everybody has different goals. Everybody has different comfort levels. But the idea is looking at that withdrawal rate and making sure you don't outlive your portfolio. So if somebody doesn't spend a whole bunch of money and they can live off of Social Security alone, right? They're not worried about anything other than inflation. But if somebody spends a lot, then they're definitely going to be worried about what their withdrawal rate is and making sure that they manage that. And so the longer we need to our portfolio to last, right? Then the lower that withdrawal rate needs to be. So in this example, you will see that if you have a 3 to 4% withdrawal rate, you're pretty much not going to outlive your assets, right? Depending on what happens with the market. Again, obviously subject to the market, because we could say, what, I have $5 million. I only need, $200,000 off of my portfolio, and so it works. But if your 5 million turns into 3, right? If the market suddenly drops, then our withdrawal rate will change too. So it's important to continue to manage this as we're looking at the portfolio. But as the younger we are, the lower the withdrawal rate needs to be. The older we are, the more that withdrawal rate can be, and not have a risk of running out of money here. And again, in this example here, it assumes inflation at 2, investment returns at 5. So a lot of people will say, well, that inflation rate, maybe is a little low. But then I can say, well, the investment return is probably a little low too. The idea is not so much about what each one of those is, because typically, if we look at here, during high inflationary periods of time, typically investment returns are good. So as long as we are still making, in this situation, we're making 3% more in both cases. So inflation was higher, but the market was participating. The numbers still look the same, right? So it still supports our 4% withdrawal rate for having over 40 plus years of cash flow needs. So the next thing is, once we've established all of the plan and we know what you need to spend, then it's a matter of, again, kind of how do I recreate that paycheck, right? So how do I manage those distributions? Which accounts do I take it from? Do I need to use my IRA first? Do I look at my brokerage account? Which ones do I do? And again, there's no right or wrong answer to this, because it's very different for a lot of individuals. We will find, potentially that a lot of people mostly have everything in traditional IRAs, so that pre-tax bucket. It's not right or wrong. It's just a function of the investments that we had available to us while we were working. It's very different now for a lot of people who can now do Roth 401k contributions. You can even do conversions of Roths within your 401k. And so it's very different for individuals. But we want to look at that and say, okay, where is your money? How much do we need? What are the tax brackets today? What are the tax brackets in the future? And creating that distribution strategy. A lot of times nobody wants to pay more than their fair share of taxes, and you want to keep your tax bracket low. So if we have a lot of brokerage money, that's, after tax money that we just pay capital gains tax rates on, you can not touch your IRAs and basically you might not pay any taxes in a given year. And a lot of times people will love that. They'll say, I didn't pay any taxes this year, and that's great. And we feel great. And that is a good thing. But the problem is we might be delaying tax consequences later on down the road, depending on where your assets are. So it's important to look at the asset types. We have 3 buckets. We have that brokerage non-qualified bucket. We have the pre-tax traditional IRA bucket. Then we have the after-tax, which is the Roth, the tax-free bucket there. So looking at those and creating what that looks like there, and forecasting what our taxes are today, as well as what they're going to be in the future. What most people don't want to do is they don't want to pay no taxes now because they're living off of brokerage money, and then suddenly have a spike at 73 or 75, right? So we kind of want to smooth out that curve there. So part of that is figuring out, how do I, take that out from the buckets? Do I maybe want to keep my taxes low because I might want to do some Roth conversions, right? So different strategies there on what my plan looks like and what's important to me on there, right? So when we look at all of the different sources of income, different taxation levels when we're putting that together. Obviously, Social Security is taxable up to a certain extent, depending on what your income is. So 85% of that can actually come back into your plan as ordinary income, which is the highest tax rate that we're looking at. Your pension and annuity income, taxed as ordinary income. Now, if you take a lump sum, obviously that rolls over to your IRA. So this is specifically talking about choosing to take the monthly annuity here. Interest income, so any of your CDs, money market accounts, things of that nature are typically going to be taxed ordinary income. IRAs, pre-tax IRAs, 401k distributions, ordinary income. Dividends, little different here depending on their status. So ordinary income if they're non-qualified, and if you've held them for a longer period of time, then that can be qualified dividends, which will be taxed at long-term capital gains tax rates. And so long-term capital gains tax rates are much lower than your ordinary income. So they're either 0, 15, or 20 for individuals. So those are much more favorable for people. Roth IRAs, obviously subject to no taxation there. And then if you are just selling off, principal of an investment. So, after the gain, whatever that cost basis is, then that'll come back to you as no taxation. So when we're looking at all of these different sources, not everybody has all of these. And so we look at either creating different sources of income to kind of vary. We can't control the tax brackets, but we can make sure that as the tax laws change and the tax brackets change, that we can make sure that we have a little bit of flexibility to move in and out of those assets as well too. So the last part of kind of that overall step of retirement, of the planning process, is that monitoring and reviewing again. So once we've kind of gone through this initial phase, taking a look at that, some people will go longer than other people from kind of having to make adjustments. But again, very important to monitor it. Some of the big things that I will see as we're going through this that we wanted to talk people through that might cause some changes is monitoring the spending. That's a really big piece of it there. That if we planned on somebody spending, X amount and they're either spending more or less, right? Kind of figuring out, why is that? Did we not know what we were going to spend? And so maybe we were off on our expectations, or if we spent more, why did we spend more, right? Maybe we just traveled extra this year, or maybe we had some healthcare expenses, family expenses, things of that nature. So really looking at the expenses is the first and foremost piece that we want to look at, because that's what the whole plan is based upon. So make some adjustments there if you need to be looked at. And then the other piece that we're definitely monitoring is your overall portfolio performance, right? Did we have a good year, a bad year? How did that impact our portfolio? Because that can definitely change where we take our money from. It can change our R&D projections later on down the road, estate tax projections, things of that nature. So that's really what we're looking at from a monitoring standpoint. Part of that is also, any pending tax law changes, things of that nature that we want to capture. And then reviewing it is also more so of just kind of making sure that where you're on track, and that if there are other issues that have come up in your situation that maybe we need to address during that time. And reviewing it and monitoring it on different paces. Typically, I'm reviewing spending on an annual basis for individuals because, again, things are kind of looking at a monthly or quarterly doesn't really show me what the whole year looks like. So, and the market as well too. I really need to look at the market on an annual basis. But from a reviewing standpoint, a lot of times things can change in your situation either more frequently than that as well too. So we'll typically start out reviewing officially, every quarter, just as we're kind of in this new phase. And then there might be a time to where things kind of settle in, and then maybe you personally don't want to do kind of quarterly reviews, and you might go on to a different schedule. But for sure, once a year, official reviews to monitor all of those things as well, so that we can capture with that. So again, kind of letting you know some of the different things that we're looking at here. Obviously, assets, really from a market, standpoint. Any income changes, so maybe we elected Social Security, maybe a pension will now start. We turn 65, and maybe there was a pension that comes in at 65. Monitoring that spending, monitoring the portfolio, depending on which allocation we're in. If we're in a dynamic or fixed or something like that, do we need to make some adjustments within those? The withdrawal rate obviously is something that changes inflation, right? Kind of thinking about what's going on. Is that having an impact on the different things that we're faced with? Sometimes we've seen, obviously, like insurance, like whether it's homeowners, car insurance, healthcare, those kind of things. Sometimes maybe if we need to make some adjustments because those have inflated much faster than everything else, we'll make some of those adjustments. And then the last one is the goals, right? Again, you might go in with good intentions of knowing that everything is, you have all of the answers, but then maybe something else might come up. You might want to help your kids a little bit more, or maybe you aren't going to do any part-time work, and we need to kind of readjust what's going to be going on in that situation. So then the idea is to make those adjustments sooner rather than later, right? So if we're monitoring the situation at a minimum on an annual basis, then we can catch these things. What we don't want to do is we don't want to go 5 years down the road and suddenly be made aware of something. And I could have corrected it years back. If I see people, maybe spending is the biggest one that we'll typically see. If they're spending a little bit more, right? Like we're having those conversations to say, we can continue to do this, but I need you to know that we're only going to be able to do it for so long, right? Or this is where we're going to be headed. So making some of those adjustments early on, if I see that we're getting off track, off the path, get back on the path as soon as possible so that we are not so far off that we cannot correct and pivot back to where we were. The spending strategies, again, kind of making sure, did we overestimate, underestimate? What are some of those things that we need to adjust? The withdrawal investment strategies most of the time are just changing over your own personal goals. Maybe the market has changed, and so there's some different opportunities, or the market has just moved a different way. And now suddenly there was a strategy that we didn't like originally, but might actually work for your situation now. So those are some things to kind of keep in mind as we're reviewing all of that. The last piece that kind of want to really focus on was that emotional piece of it. When I mentioned before that, people gain in percentages and lose in dollars, that's really the way that it is there. And so obviously you have a cycle of emotions. And this is going to be driven by mostly the stock market in general. It really has no bearing on anything else here, right? And so you'll go through, in a good market and be really excited about something. The market starts to move down. You get a little nervous, and you kind of go through the different emotions of that nervous side, and then you kind of panic and move things. And so my job as an advisor is to help you manage all of those kind of things and prepare you, because this will happen for most individuals, because nobody wants to lose money. So we want to kind of minimize the downturn of those market emotions so that you at least are a little more comfortable with what's going on there. There's always going to be a reason to kind of, say there's going to be, a worse time the market is headed in a downward turn. Always going to be recessions and corrections. That is guaranteed in the market. So we just need to make sure when that happens that you're comfortable with it. And the only way you're going to get comfortable with it is by having a plan to be able to address that, so that you know that you will be okay and you won't have to change your lifestyle just because the market is taking a downturn here. So again, these are just some highlights here that you can just see through different periods of time, that there's always something going on, and always the reason to get out of the market and try to get back in. The idea is even through the worst of it, which I personally feel was 2008. That was one of the bigger ones. That most people feel, that the market did recover. It was very painful and uncomfortable, right, for a lot of people, but it did lead to the longest bull market that we've had, right? But we just had to be able to stay the course to get there, right? So the idea is creating this plan so that we can ride out all of these here. Again, kind of like, how do those recessions, play on your emotions and all of that there. There comes a point to where sometimes for some people, you're okay, right? You're like, oh, I'm so glad I got out, because the market just continues to drop. But you have to make two right choices. It's easier to kind of get out of the market, right? You can kind of see here that, I'm happy that I got out. I'm happy that, I'm missing out on all of this, because you can look at it and say, okay, things don't maybe look, that great over the next short term. But the problem is knowing when to get back in. And that's the piece that we're never going to get right? You're going to look at it and say, the market's going up, kind of this rally won't last. The market's going up, you're like, oh no, this is just temporary. Like, they're just kind of coming back. And then it continues to go up and missed out on it, right? And so that's the part that, again, that we're trying to avoid. So I want people's risk tolerance to be through the good and the bad times of the market, not the current market conditions. We're always going to lose if we're chasing that there. Again, so that emotional risk tolerance, there's different components to risk tolerance. There's the financial numbers, right? It just says, like, where should I be, right? Like, where should my overall risk tolerance be based upon my goals? And then there's the emotional piece of it and the behavioral piece that are very tied together. So the emotional piece is, how do you feel about what's going on? Does it keep you up at night? Do you have a sense of concern? Do you call your advisor, a couple of times just to really talk about it and kind of going through that? Then that behavioral part is when our emotions get out of control and we actually take action to do something in our portfolio. And it's okay to restructure your portfolio and maybe, make some adjustments from an overall, investment choice. But to actually drastically say, I'm going to get out, or I'm going to sell all my equities and go to bonds, or vice versa. Like, those are those kind of things where the emotions eventually cause you to take action. And so again, right, kind of going through this whole planning process and building a portfolio that will kind of protect you on that. So the idea is to try to get, for most individuals, the highest market return with the least amount of downside and volatility, right? Like, that's everybody's goal. So when the market's doing, what it's doing, we all want to participate, but nobody wants to participate in the downside. And so we're not going to be able to do that. So we try to find that happy medium for some people, and the different approaches will allow you to do that based upon your situation as well, too. So again, bottom line, have a plan so that can help you solve all of the risks that you have later on in life in the pathway to get you to retirement as well, too. So the idea is, when we look at, are you ready to retire? Some kind of things to think about is envision what retirement looks like to you, what's important to you. Right? That's the one thing that I can't help people with. I can help them brainstorm and do some of those kind of things, but it's a matter of what's important to you, what do you want it to look like, and then kind of understanding those risks and having those conversations with your financial planner and creating that plan, reviewing it and managing those decisions and those emotions as you go into retirement as well. So one of the things that we would let people know is that when you're considering selecting an advisor, if you are not currently a client of ours at Bogart Wealth, or have an advisor, or are looking for an advisor, really, I think all the things that we talked about today are things that that advisor should be talking to you about. They want to make sure that they're a certified financial planner, so they're looking at all these different aspects of financial planning, not just the investment piece, or not just the tax piece, things of that nature. All of these things are very much tied together. And looking at your plan, not a plan that's for everybody, knows the IRS rules, has navigated all of these kind of things, and manages all of that, and discusses, a lot of these strategies, and really works with you so that you understand why you're doing what you're doing, and helping you and guiding you in making the appropriate decisions for you. That, again, like I said, when we're retiring, typically people only do it once, right? Unless you choose to go back later. But if you choose to go back, we want it to be, it's because you choose to, not because you have to. So making sure all of those things are good qualities that you're looking for, and that you're able to get what you're looking for from that advisor as well. So I will leave it open now. If there are any additional questions or anything coming through on the chat, I don't see anything on here, but I will stay on here for a little while just in case somebody has anything additional. If you have not met with one of us here, I would encourage you to have a consultation with one of us. You can go to our website. You can give us a call. Be more than happy to schedule a one-on-one. And if there are things on here that you have not addressed with one of us or an advisor, again, please reach out to us or your advisor, and we're more than happy to talk in detail about your specific plan. So I hope everybody enjoyed the webinar today. It will be posted in a couple of days on our website as well too. So if you wanted to go back and revisit any of the slides or take a look at any of that information, please feel free to do that. I hope everybody has a wonderful day.